Hello and welcome to our AIM Summit webinar on the U.S. elections, all about the K-shaped recovery and expected inflation. This session is sponsored by Saxo Bank. I am your host, Zachary Sefrati, the CEO and founder of Down the Capital and strategic partner of AIM Summit. We have so many people dialing in today from all over the world. We have people participating from over 30 different countries, including institutional investors, family offices, high net worth individuals, and leaders of the financial industry. We will be having a Q&A session after the presentations, but feel free to submit your questions as they come throughout the session. There is a Zoom Q&A dialogue for those of you watching the session live at the bottom of your screen. If you're joining us on YouTube, unfortunately, you won't be able to participate in the Q&A, but please do like and subscribe to our YouTube channel now. Introducing our partner at Saxo Bank. Saxo Bank connects people to investment opportunities in global capital markets. As a provider of multi-asset trading and investment, Saxo strives to empower people with a user-friendly, seamless, and personalized investment platform that gives them exactly what they need when they need it, no matter if they want to trade actively in the global markets or invest into their future. We've been using Saxo Bank, working closely with the organization for a few years at Downland. I can tell you they're great. They have amazing software, super customer service, and it's a great organization to work with. It's my pleasure to introduce today Steen Jakobsen, who is joined Saxo Bank in 2000 and serves as their chief investment officer. As CIO, he focuses on delivering asset allocation strategies and analysis of the overall macroeconomic and political landscape. As the head of the Saxo Strats team, Saxo Bank's in-house team of experts, he's responsible for all research, including quarterly outlooks, and was the founder of Saxo Bank's renowned Outrageous Predictions. Prior to joining Saxo Bank, he worked with Swiss Bank Corp, Citibank, Chase Manhattan, UBS, and served as the global head of trading FX and options at Christiania, now Nordea. Jakobsen's approach to trading and investing is thought-provoking, and he's not afraid to counter consensus. This frequently sparks debate amongst the global markets community. He has, on a daily basis, he and his team conduct research across asset classes, covering major macroeconomic developments, market moves, political events, and central bank policies. With more than 30 years of experience, Jakobsen regularly appears as a guest host on CNBC and Bloomberg News. It's my pleasure to hand over to him for a 15-minute keynote, which will be followed by John Hardy, the head of FX trading, who I'll introduce after Steen. Thank you, Steen, for joining us.
Thank you, Zachary. It's a great honor to be in this great forum. And I look forward to, in 15 minutes, solve all of the issues we have in the world. If I could, of course I can't, but I'll do my best anyway. So welcome everybody. A very big mouthful in terms of introduction, but I think the main objective of anyone who does a presentation is to create some kind of a thought process as the seminar is over. And for us, it's always been not to be right, but to raise the critical question in what is incoming in the next 3 to 12 months. So in the shape of the next 15 minutes, I will try to talk about the K-shaped macro world and why the letter K is so significant, both for what has happened and transpired already, but also what is incoming. Inflation or inflation risk, or rather, when I talk about inflation, I should probably stipulate that I talk about inflation expectation. And finally, on the request to some extent by Zachary, I want to touch on the China-US technology rates, which I think has become even more dominant over the last 2 days, considering that President Xi yesterday had a big speech about the self-reliance on China. So we'll try to touch on those things and then leave the word to my honorable friend, John Hardy, to take care of the foreign exchange and more liquid side of things. So I'm a big fan of the letter K because it really explains the world post-COVID-19. Pre-COVID-19, we had inequality, we had the technology rising, we had problems with the productivity and everything else. But what COVID-19 did, to my mind, is to accelerate all these trends. So if you look at the higher end of the K, you have an increase in technology, you have an increase in fiscal stimulus, Fed balance sheet, the non-solutions, I have called them, which really essentially is to issue more debt and debt issuance, and through that try to mitigate the fallout that we have from COVID-19. There is increase of social riots. The top 1% is getting richer. The political atmosphere has certainly turned towards and in favor of autocracy. And of course, as I talked about, inequality. On the downside, less employment, less productivity, worsen social fabric, less innovation, simply because the monopoly of the technology companies, which young people love to call platforms, what I really call monopolies, which is what they truly are, is a hindrance and a barrier to entry for new innovation. Basic research has never been funded with less capital than it is right now, certainly in the public space, but even in the private space. The educational system is being undermined by corruptness in the case of the US to a large extent, and by the number of actual lessons that people receive today. Denmark, which is deemed to be one of the best educational systems in the world, have 30 to 40% less educational hours per student per year than I had when I was a university major. Macro-based economics is dead. We simply do not have price discovery anymore. We have basically every single market in the world controlled by one shape or form of a government entity. We have no privacy left in the world. And in terms of globalization, of course, that's reversed. That is the setup. And the problem with the K is that, and let me go straight to the conclusion, there will be more K coming, and ultimately the K needs to break, but that is the conclusion. In this case, I use the old good Clint Eastwood's movie here, The Good, Bad, and the Ugly. The good thing for the markets is the fiscal and Fed balance sheet expansion. The Federal Reserve has guaranteed us they are on hold forever. In their own wording, they are not even considering having a consideration about raising rates. Fixed income is probably dead as an asset allocation tool. It offers no protection from a correlation point of view. And if you think 72 basis points is enough to be paid for 10 years risk in the US over the next 10 years, I wish you more than good luck. This creates a free lunch in equities, which we all can see and everyone is on board on. The bad thing is the K-shaped economy. It actually leads to nowhere because it makes the world move in two speeds, separate tracks, so to speak, deglobalization, inequality we talked about. And then I think the number one question I get as an economist is that when will we be back to the pre-COVID-19 level of GDP and demand in economy? And the answer is clearly never, because COVID-19 has made obsolete and made the business model we operate right now under state capitalism very, very clearly not a workable model for the future. Yes, it's workable for higher equity prices, but it is uncontrollable and destabilization in terms of liquidity provision. The ugly is, as I said, no price discovery. Monopolies keeps growing on platforms. Unemployment is now structural. A lot of jobs will never come back. We'll probably see stagflation and the US-China war. That's sort of the setup here. So what we've done at Saxo is we created what we call the Saxo Misery Index. And those of you who are old enough to remember the misery index used to be the unemployment rate plus the CPI as a misery. But here we're really using the K, where we're taking the NASDAQ 100 on the green line, and the blue line is the misery index, which consists of airlines, hotels, restaurant, leisure, oil and gas, and commercial banks. And you can see the K clearly in terms of the performance. Let me tell you that we personally think that a lot of the valuation, a lot of the good trades will probably be found in the misery index rather than in the NASDAQ 100. There are fundamental good companies in this space. And certainly if we see inflation and a yield curve steepening, something like commercial banks should have a recovery. And, if we get a vaccine, just minimum 1 year from when Trump thinks he's getting it, but sometime in 2021, of course, they can open up and release a lot of pent-up demand and with it, of course, performance. But the K is visible in the market, it's visible in the social sphere, and it's certainly visible in terms of the credit functioning of the central banks, because the fact of the matter remains, if you look at the shape of this misery index itself, the green line are companies who have infinite access to zero funding. And the lower line are companies which are financing themselves at 10, 20, 30% marginal cost of capital. So, everything is not created equal when you have a blanket check issued by the state government. It can give liquidity, but it cannot create solvency. And this is where the solvency is hurting the most. But my main point, and one point which I think the market is missing in its totality is what is the difference between the response of the policymakers in 2008, 2009, and 2020. In 2008, 2009, the policy response was entirely 100% driven by a QE, quantitative easing, expansion of the balance sheet, but with no fiscal support. As many of you remember, there was a very restrictive sort of umbrella being put on top of the EM crisis, European crisis we had in 9, 10, 11, and 12 with Greece. All of it was based on being austere. Fast forward to 2020, and we have a huge amount of fiscal spending coming in with numbers on the QE, which in just the month of March and April exceeded QE1, QE2, and QE3. The problem with the Fed balance sheet is that it reduces the velocity of money and as such has zero value for the actual economy. The liquidity provision, and more importantly, of course, the fiscal spend goes directly to the consumer. And here is what is the big difference and what potentially is creating inflation. What the central banks are doing right now is being used as a tool to monetize all debt. And what monetize all debt means is basically that the size of the Fed balance sheet from March 2020 all the way into 21 at least, and 22 as well, is almost 100% one for one, dollar for dollar, and equivalent to the US fiscal deficit. As you see on the right-hand side, the fiscal deficit in the US has been on a trajectory to be worsening or widening, and now it's at 25, 27%. Even in 2021, it will be at probably 7 to 10% of GDP. So all of that money now flows circumventing the banking system directly to the consumers in the shape of keeping people in jobs programs, in terms of extending credit, in terms of consumers. And that's why you see that the global resale sales overall in the world is holding up well. This table in front of you right now may be the most boring table that you ever seen, but it is also the most potent and the most important. On the far right-hand side, you see a number which is 17%. And if you look at the far left, you see Fed. So Fed is going to expand the balance sheet in the US between now and 2021 December by 17% of GDP. To put this number into context, if there was in your individual countries a emergency plan done on fiscally, it will normally be in the size of 2 to 3% of GDP. But in the space of less than 18 months, Federal Reserve's balance sheet is expected to grow by $3.4 trillion. The law of big numbers dictates, of course, that the bigger the number it gets, the less the marginal impact of every single dollar that you have. So in other words, this is just showing you the total frustration and the total inability of the Federal Reserve and other global central banks to activate parts of the economy. And that's why the monetization becomes a differentiator, simply because we are not having the normal velocity of money times the expansion of the monetary base, which is negative, and that's why we have low inflation. Now, instead, we have no velocity in the banking system, but almost 100% velocity from governments directly to consumer. That keeps the retail sales high, keeps people in job, and it replaces the demand lost in the overall size of the economy. This table you look at is the most potent one because it shows you there is monetization. It shows you the expected increase in Federal Reserve balance sheet, and with it, the amount of money that will flow to the US economy and directly into that 70% consumer spend that is in the economy. In other words, for us, this very table is the table and the reason why we think that inflation expectation, not necessarily inflation, but inflation expectation will continue to rise and become a major issue in terms of asset allocation. In terms of inflation, I want to just touch 1 minute on the case that inflation is unmeasurable. Inflation is a dodgy concept from the beginning of it. It's about price stability in essence. But what is price stability? For Zachary is one thing, for John is another, and for me it's a third thing. If you're a young person, you have very high exposure to education, to your first apartment, rental, and the likes. And people in my age, almost retired and losing all the hair, we have money in the bank, we have a house on the safe side, and we really only spend money on luxury goods. So understand that inflation is a loose term. But and secondly, and most important, as this chart shows, inflation is institutional. During the early 1980s, Federal Reserve and the New Zealand Reserve Bank of New Zealand decided that 2% inflation targeting was the right number. It's totally arbitrary, and it's based on a social democratic government in New Zealand dealing with, at the time, a 10% inflation rate, said, why don't we try to get it down to 2% and see how it works? Since then, the whole world, without any consultation, without any proper analysis, has dictated that 2% inflation rate is the correct rate. I think you can argue that in certain parts of this business cycle, 0% inflation is good, and in other parts is 6%. So this whole constitutional, institutional way of doing inflation is wrong. And now Fed has actually told us they agree. They will not admit so much, but what they've done is they adopt a new strategy that will allow the average inflation rate to exceed the 2% ceiling, which they have kept for 40 years in place. The same 40 years where fixed income has outperformed, and through the extreme, relatively tight monetary policy have forced both inflation and interest rate down. Now Federal Reserve is saying we could not ignite and create inflation over the last 40 years, but certainly if it gets above 2%, we can kill it. Of course, that is the most naive premise ever in any policy. And I will say this on a public record, which I've done many times before. I have a lovely dog called Nelly, which is a golden retriever, which is about 90% better at predicting the US economy and inflation than any of the 150 PhDs that work for the Federal Reserve. Actually, recent analysis of the Federal Reserve's research work shows that they have an extremely high bias in their analysis and in their forecast. Just look at their projection in terms of the Dutch calendar they use. It's been wrong for 20 years running. Which is nearly more than the time it's been around, but certainly do not trust Fed. But now they're telling us they can control inflation. On the right-hand side, you see the market's measure of inflation on a daily basis, which is called the five-year inflation flop, and we are already exceeding 2% and moving higher. The point on inflation is really, it doesn't really matter whether it happens or not, because as long as inflation expectation goes up, the underlying inflation will follow suit. And in that respect, also remember, if money is going to flow out of some instrument, I think the most likely one is overall government bonds, then it's going to flow into buckets of risk like inflation linkers, commodity and gold, which are far smaller in size than the pocket of money they come from the beginning. I'm so old that I actually believe that US yield curve or yield curves overall tells you everything. So we've done a number of works at Saxo that shows that the shape of the US yield curve is the best predictor of volatility, but also of inflation. And here there's a chart we have borrowed from BCA research that shows that if you align the consumer confidence index with the overall yield curve, then we are in front of a massive steepening of the US yield curve, which would equate to that 10-year US interest rate pretty much moved from 72 basis points at the time of talking to about 200 basis points. So get this point straight. The world is barely able to create, actually is not able to create any growth at zero interest rate. Imagine the actual free money price of the market moved up 100 or 200 basis points. It will show that the market that has no ability to sustain that. This, of course, will be met by yield curve control by the Federal Reserve, but the yield curve control is very difficult to do across the curve, which means that 30 years is more at risk of rising in yield than 10 years, which we must expect Federal Reserve to control. But what it also tells you is that volatility will increase. Translated into sort of your investment trading, it means, yes, you can probably make money in the equity over the next 12 months and the next 5 years, but your return will come with increased volatility overall. In terms of the US election, when we initiated this summit today, it was pretty 50-50 who's going to win to the election. We just published our Q4 outlook where we say there are really three scenarios: a contested election where Trump is not going to concede, a clean sweep by Biden, which at the time was a big surprise, but now is the consensus, and then less than 20% probability of Trump of winning. But let me state this, because I've done a number of interviews on this year's election. I think that Mr. Clinton and Mr. Biden are the two most terrible candidates that's been in the history of US presidency. I said that the last time we had Clinton versus Mrs. Clinton versus Trump, but I think this time it's worse. We have two guys who are, both of them mid-70s. One is senile, the other one is clearly a guy who's lost his marbles. And none of these guys represent any changes to the outlook. So if you're sitting here today and thinking with like the rest of the market, a clean sweep by Biden will be okay. We can live with increase in tax rates from 21 to 26% because he's going to come in with a green climate transformation plan. He's going to be spending money on infrastructure. forget it. I lived in the US. I understand the US structure. Already in 2008 and 2009, you could have done all the infrastructure you wanted for zero funding cuts from the federal government. But as infrastructure in the US is based by state, and it needs to be on the purse of the state by state, it's not going to happen. So this concept that Trump or Biden is going to make a change for it, it doesn't matter. I think John will argue, and I make him make the case himself, that the worst case scenario is actually Trump winning, because if he does win, I think that is extremely unlikely, but if he does, then there will be an outbreak of social rioting in the US, simply because his Make America Great army is going to come into full throttle, and it will create diversion in the US society. And I just want to stress that I'm not someone who thinks that Trump or get personally annoyed by Trump. As you can see in the lower part of the slide, I actually was one of the few people who believed in Mr. Trump last time, but I did it because, as I simply said, Hillary Clinton cannot win the US election. I thought she was the worst candidate ever. She spoke to every single minority in the world. She had no vision. But now instead, 4 years later, we have two people with no vision and no future in terms of the US. So I expect whatever and whoever wins it will be pretty much more of K, as we saw before, more division. It will be a lot of noise, but not something that changes. And for the record, we have tested election years statistically in terms of the equity market. You are not able to see any seasonal change in terms of an election year versus a non-election year, meaning that essentially US election and the return on the equity market has zero correlation. So whoever wins the election is not what matters. What matters is what the part of the business cycle you're in. And then on to China, which I think is the most important thing. For 2020, our number one call was that climate would outperform as a contribution to your portfolio. I'm now willing to say that in 2021, I think the outperformance will be your ability and willingness to engage and take a higher weight into the Chinese market. I think the fact that they're going to a Chinese-based cryptocurrency, the fact they're moving to their own platform, the fact that they're moving aggressively into substitute anything they buy from the US will mean that 60 to 70% of all IPOs around the world in the next 10 to 20 years will come from China and platforms like Tencent, Alibaba, JD.com, and the others. So if you want outperformance in a zero growth, zero productivity environment, you want to be where the technology is. So for us, for me at least, I think there will be a huge substitution of the classic American names for the Chinese names. And I'm not saying that to be politically biased. I'm just saying that as an investor, if you look into the future, where can you get excess return? It is in the growing depth of the Chinese market, the opening up that needs to happen with the cryptocurrency that they're issuing, because with the cryptocurrency, they get better capital control. They can allow flows to go in and out from foreigners, but they can curtail whatever the domestic audience do in terms of tracking it. What people miss to some extent, and what this chart shows, is that when we talk about two platforms and two worlds, it's already happened. Look at this, is the inter-zone business. Asia Pacific does 53% of its business with itself. And this is 2 years back, this chart. Today, it will be 65, 70% of all business happen up and down the corridor in the East. Equivalently, in NAFTA is 40%. And look at the EU, where I sit, 63% of all business happens internally. So this concept that the trade war is the issue, I think is wrong. What is the issue is that in the technology side, China leads in 5G and AI. They have the most amount of IPOs, but they are now also being the most proactive in terms of controlling the protocol that sits underneath the technology of 5G and AI, which means that, US will not accept that. I will need to go with its own protocol. So sometime in the future, both as a country, as a company, as an individual, you need to decide whether you want to split your money between the two or you want to go with one or the other. Huge difference from today where we have a globalized world. And to move on to the sort of more up-to-date agenda on China, I've taken three things into this chart. Number one, Vice President Xi over the last 2 days has been doing the tours of the reforms and opening up parts of China, and he's called for self-reliance. Self-reliance sits actually very close to the Mao legacy, and now they're moving into the industrial sector. In the mid-size, you see that 13,000 Chinese companies has registered as semiconductor companies. And you can laugh at the fact that these are anything from refrigerators producers or whatever. But remember, the Chinese technology system is the most capitalistic in the world. When you see an Alibaba, there is 10, 20 years of infighting going on between what started with 10, 15,000 companies that wanted to be what Alibaba is today. So China is in many ways a bad-sized or badly run sort of system when you get to the aggregate level, but in the sort of microstructure of technology and microstructure of everything, they have extreme capitalism. And on the left-hand side, you see that President Xi again reiterated Shenzhen's position as the opening up, the first place that China open up, and they are going full throttle to create and reduce a China which is not reliant on the rest of the world. They have enough domestic demand. They will grow the capital market through the use of blockchain and cryptocurrency. They will start opening up the capital account because then they control the outflow. I think these are major changes to the way we do business, is the way they do business in China. And to extent that's ignoring the US-China relationship issue, I think this is a huge game changer. Just to point out that what is going on in the world, I also want to talk to the fact that the two weakest sectors credit-wise you could find in the world right now is European banks and the CMBS, hotel, retail, and offices. So while the stock market is making new highs, some of the most leveraged part of the economy, some of the most exposed to the main street, the European banking system is making all-time lows. I repeat again, European bank as an index, the 600 banks in Europe is making all-time new lows. The CMBS, the corporate bond structure of hotels and retails and offices, also making new lows. So yeah, you can create enough liquidity to get the market going. You can create some demand through transferring money to the private sector, but you cannot maintain solvency, and solvency is a big issue. Just to point out that the volatility is something that needs to be in your portfolio, but I come back to that. This is the highest, most anticipated election in history. The November election trades at 30% vol, which is 2 times approximately of the average vol, which is about 16% going into election. So we know it's already a big vol event. Maybe it's priced too high, maybe it's not, but the fact of the matter is volatility continues to rise. And then just want to end on the fact before I leave to John. So how do I play this market? This is the model that I use personally, and is Saxo's overriding model. So we have a classic equity 35%, fixed income 20%. Well, where you find we are different is that we have exposure to volatility, and the exposure to volatility because it's the only asset that are negative correlated to risk on. We have gold because gold is the only antithesis you have to the monetization and debasement of the dollar. We have inflation linked because simply there are no allocations to inflation in a world which is becoming unhooked in terms of globalization, which is becoming strategic in the way they onshore, strategic in terms of they source critical infrastructure, things like hand sanitation and the likes. And of course, commodities because it's trending, and we feel very, very dominantly that the agriculture sector is expensive. So you can see the weights on the left-hand side. Everyone gets the presentation. I'm not going to spend a lot of time on it, but what is interesting is that if you put that all into a model, you can see that you can have a Sharpe ratio of 1, which I think Zachary will agree is a pretty good Sharpe, with a maximum drawdown of 14% for a very allocated model. I know all you guys are 80-20 or 70-30. I'm just saying, do whatever you want in terms of your risk on. I'm not going to argue with you, but I beg you all to have some exposure to volatility, to gold, to inflation, a commodity, to offset that on risk. I buy the concept, the K, the technology, the healthcare, the evolution of the market, the equity is a better place to be for the next 10 years. But I do not buy the concept that fixed income is your balancing sort of coin. Your balancing coin in the future will be volatility, gold, inflation, and commodities. So conclusion quickly for me, short term, we get more K with higher volatility. Medium term, we get even more K, but with inflation. And I think the only platform I can see that unifies the ability, the shortage we have on productivity and models and everything else is the green platform. Thank you very much. And over to John.
Thank you, Steen. That was an excellent presentation. You covered so much in such a short amount of time, and certainly looking forward to the Q&A session. I'll just briefly introduce John Hardy, who joined Saxo Bank in 2002 and has been the head of FX strategy since October 2007. He focuses on delivering strategies and analyses on currency markets as defined by fundamentals, changes in macroeconomic themes, and technical developments. Hardy has won several accolades for his work and was named the most successful 12-month forecaster in 2015 among over 30 of FX Week's regular contributors. His Forex market column is often quoted, and he's a regular guest and commentator on TV, including CNBC and Bloomberg. John, excited to hand over to you and hear more expansion on Steen's presentation, as well as some insights into the FX markets.
Thanks very much, Zachary. And I will see if I can share my screen appropriately here and get to the right slide as well. Yes. Unfortunately, starting mid-presentation. Okay, so I'm going to be touching on a lot of the themes that Steen brought up, and my overall push here is to indicate that I think that the US dollar really is the most important currency to track. No surprise there. It is the most traded currency in the world, and it is the global reserve currency with so much of trade priced off the US dollar. But the US dollar itself is so critical in supporting or hampering recoveries, global and local. So here we have on slide one, looking at the dollar, which you can see in dark blue there. And then I've done an inverse of the MSCI emerging market. It just shows you, I think you can see the correlation on the chart that, for example, emerging markets, you almost don't need to bother to decide what to do. It's all about whether the dollar is going up and down, because these companies or countries are trading off of flows, and the dollar is so critical. In fact, many studies have shown that you almost don't need to choose an equity market when you're looking, or choose equities specifically. When you're looking at investing in emerging markets, you can simply buy or sell their currency. You get almost all of the return from the flow in and out of the country, which is of course a reflection of investor flows going in and going out as credit and the dollar are going up and down. So why does the dollar need to fall to support a recovery? It's quite simple. It's what so much of the global debt is denominated in. We have too much debt globally, also in emerging markets, but around the world in general. It needs to be, the dollar needs to be weak to prevent this real load of this debt from rising. And its overvaluedness is contributing and is a constraint on liquidity. Really long term, though, it's not just about a weaker dollar, but really is about the dollar is its sort of dysfunctional use as the global reserve currency. We really desperately need another global asset. Steen touched on that with his discussion of the Chinese digital currency. I think we're going to have a dollar rival, and we'll see maybe the outlines of that emerging as soon as the next year, although these things always take a lot of time to get into place, as the current setup with the Chinese yuan is not there. So let's look at the crisis response from a fiscal side in the US. Steen already showed this, and the projections he showed were even more dire than what we're already seeing. 15% of GDP on the budget deficit side. That's relative to the unprecedented 10% after the global financial crisis. And then prior to that, around 5% was the typical max you would see on a budget deficit, excepting World War II, where we saw, of course, even bigger ones. This time around, it's 15%, and it makes you wonder at what level can the market continue to absorb U.S. Treasury issuance. Of course, the Fed is monetizing this, but our platform is that this leaks into inflation, and that as well, without credibility on the real interest rate side. In other words, the US Fed is offering essentially 0% and could be offering close to 0% out to 10 years if it does what yield curve control, and if inflation rises to 2, 3, even higher percent in the US. Who wants to even hold a dollar? Certainly not a treasury if the real yield on that is minus 200 or worse basis points. Note as well how long it takes to recover. You have that extreme acceleration back in 2008 and into 2009. And it took many years to get back to sort of almost par from where it started the crisis. And then this time around, we actually had Trump doing irresponsible, massive tax cuts that were actually at the top of the cycle, seeing even larger deficits before the COVID-19 emergency response. Now, even in the short term, we have prospects for more US dollar liquidity. On the right, you can see this little small inset chart. That's the actual expansion in the Fed's balance sheet from its regular purchases. The overall balance sheet is flattened out a bit recently, the green line on the left chart, because of various technical reasons, FX swaps and other things that make it look like the Fed's balance sheet is not growing, but it certainly is growing. And those technical aspects will fade in importance, and we'll continue to see the Fed essentially monetizing deficits. And as well, the Treasury, and preparing for this crisis as it was unfolding, actually saw its actually had a number of treasury auctions to increase its cash holdings to respond to the crisis. That's the black line you see in the chart, and actually to the tune of $1.7 trillion. So it has quite a bit of artillery here to shoot into the economy. It just needs the Congress to figure out whether, and the president to agree on some sort of spending program, which may or may not happen here ahead of the U.S. election. Looks like the prospects of that are fading, but it's like you have a dam of water, of potential liquidity out there, that once the spending rules get released, this adds to dollar liquidity and should help to weaken the dollar, whether that's beginning now and up to the end of the year, or not until the very early days of the new administration, whether it's Trump or Biden or otherwise. And we can see, of course, that the U.S. is not alone in running deficits, but the scale of a country like Australia, which is at a similar degree of crisis, their projected deficits are more on the order of 6 to 7% out a couple of years, and have a much lower starting point in terms of their overall sovereign debt load. And I think this chart really shows a lot and sort of illustrates some of the things that Steen was talking about as well, in terms of the crisis response, which in the U.S., if you look at a country like China, when it went through the crisis, when it responds to it, it's a little bit less focused on people's incomes, and it's more about investing and inciting economic activity on the industrial production level, storing up strategic reserves, these kinds of things. In the U.S., with a much more flexible labor market, it's very easy for companies to fire people. With the gig economy, many people, millions in fact, find themselves without work. And then the rush is to provide for social stability, to replace people's incomes, rent money, basic money for consumption. So it's just a massive cash splash onto the economy, to such a degree, in fact, that top black line, and excuse the quality of the chart, but I thought it was just a great illustration from a Bloomberg commentary piece from John Authors, who has a great column, by the way. It shows that actually U.S. incomes grew to a degree we haven't seen in modern history. So worst crisis ever, and people, especially at the lower end, finding themselves with more money than they've ever seen. And that actually saw that retail sales, for example, recovered to new all-time highs in very quick order. But the cost of that could be negative real interest rates, inflation, because you're getting no productivity, you're getting no extra work done into the economy, no increase in real GDP growth, but you are getting expanded income levels. It's not the best mix for currency fundamentals, for sure. I think Steen covered very much the Fed's balance sheet. Now let's get to what the market is predicting here, and that is one of the key drivers for why the dollar has weakened quite a bit since the levels, especially during the crisis, but also to a degree where they were before the crisis. And that's the real interest rate. The market is very afraid of the nature of the policy response in the US, and that it'll continue to drive real interest rates much lower. And you can see that reflected here, where I've used these so-called five-year break-evens, and then overlaid that on actual inflation. So the blue line is the US. Real rates in the U.S. are predicted to absolutely collapse from relative to where they were, which is actually in positive territory. If you recall, the dollar was quite strong prior to this, heading into early 2019, for example. And Japan, they've never really managed to get the inflation up. So their real rates are actually slightly positive. Europe's are very negative as well, but they've just kind of been that way for a long time. So that closing of the gap is really what's helping drive the fundamental story for the US dollar. And you can then see I've made a spread of these on the blue lines here, and you can see how that supported the recent rise in the euro dollar from 110 and below to all the way to as high as 120. Whereas back in, for example, that big 2017 rally in the euro, where the market was predicting great things for the EU economy and some sort of normalization, the inflation picture, the real rates picture never improved, and that was not reflected in that real rate spread, whereas the Fed did continue to normalize policy rates and was driving a much more significant real rate rise in the US. And the Japanese yen from this type of model looks even more mispriced. Dollar yen should theoretically be trading considerably lower, well below 100, if these real rate considerations carry any weight, which they absolutely should. As a currency losing its purchasing power by definition means it should be weakening. And you can see how the excesses of the crazy Bank of Japan policy, it seemed crazy at the time back in 14 and 15, and even starting in 13, drove dollar yen all the way to 120 to 125. but that real rate spread was never up there, and it was hard to sustain that dollar yen rally. And actually, we're looking quite closely at dollar yen for a significant technical break of the 105 level. Be eyeing that level closely. You can see how many times it sort of touched close to there since all the way back in the early 2018. Euro yen, by the same measure, is actually very misvalued as well and should be trading considerably lower. I've speculated in recent days that a lot of this is heavy Japanese interest in speculating in European peripheral debt. You've made tremendous returns being long things like Italian BTPs all the way since, really all the way since the election saw the big blowout in yields in 2018. It's been a great trade. At some point, this trade fades, but it's just a phenomenon that's not available in the very moribund and boring Japanese government bond market. So it could be one driver for why euro yen is sort of held out for this long. And with this chart, the only thing I want to draw your eyes to here is that the market is aggressively pricing these things. So this is in the expectations, which Steen emphasized are so important for driving the inflationary genie for whatever it controls it. And it's so aggressive, the market expression of its expectations for U.S. Inflation to pick up, that those inflation protected treasuries that you can buy, which are where the bond price is adjusted to the CPI, are actually trading at a yield currently of minus 100 basis points. So you're actually locking in minus 100 basis points if the CPI fails to actually increase here. That's relative to the nominal yield on 10-year treasuries, standard treasuries at 0.7%. So that spread is tremendous, and it means that the CPI for this price to be justified on these bonds does actually need to increase and increase quite consistently. I won't cover that because I think I'll get bogged down in trying to talk to that slide. It's quite interesting as we're going into the election and what's really been developing all year, in that there is a bit of a dollar short positioning wise out there. This is a chart of the U.S. Futures market, currency futures market positioning for non-commercial who are usually speculative traders. And you can see that almost all of that dollar short is focused on a euro dollar long. So maybe some tough sledding from a euro dollar perspective, but the positioning is pretty light in other currencies. And this whole break-even inflation issue has become such a focus that it really is just dominating the narrative. So I think what we'll see is that the market will be very sensitive to CPI releases, to PCE releases, anything that's sort of inflation related. As we look at US data coming in, you can see the degree of correlation of just the raw so-called break-even for the 10-year in the US relative to Aussie dollar. I mean, does Australia not have its own inflation metrics? Of course it does, but just the market trades on narratives and trades on themes, and this is the dominant theme for the moment. And importantly, perhaps for Australia being less of an issue for Australia, just to point out the specific case there, is that Australia has gone into a current account surplus status, unprecedented in this country's modern history. Its export growth is outpacing, or it's actually recently decline in export growth is outpacing, or in better shape than the demand driving the driving imports. But it's just quite a fundamental shift in this country that's quite tremendous. And the U.S. by far and away, of course, running the most massive deficit in the world. And then, as I showed you earlier, this sort of cash splash approach to addressing the crisis with just dropping tons of helicopter cash onto the economy means, what do people do? They run out and buy flat screen TVs. They run out and buy basic consumables, toys for the children. And where is all this stuff produced? Is produced in China. So we've actually seen, ironically, this massive drive aggravating the deficit between the US and China. And then holding the Australian dollar back at the same time as it's being pulled to the upside. The upper blue line here is BHP Billiton. So there's quite an interest in this reflation trade that we are actually going to see a recovery in commodity prices, hard goods. China's demand for things that Australia produces, especially iron ore, coal, etc., quite strong, and prices quite strong. That's pulling the Aussie dollar up. So you see the black line being Aussie dollar, that's just the Australian broad exchange rate, has sort of recovered in a V shape from the brief crisis sell-off, but Australian rates, just like everywhere else, have been pummeled and are basically flat. And that's going to lead to an interesting question I'll get to at the end of the presentation. Sterling, we have the unprecedented situation. UK is it's such a there's such a tension to me in the outlook for sterling because you have this very heavily discounted currency. There's no doubt on a fundamental level, this currency is trading at very cheap levels historically for the obvious reason of Brexit and the concerns about what shape this trade deal will take, etc. And there likely is considerable capital flows that are ready to be unlocked into the country in the event some reasonably amicable deal is struck. At the same time, they've been probably worst impacted of COVID. You saw the budget deficits. Their growth in their central bank balance sheet is going to be tremendous as well. They're a current account deficit country, and this is a current account deficit country that is talking about doing negative rates. This is not precedented. Usually it's the big surplus countries that are only able to do negative rates. So negative rates would be a big, profoundly fundamental negative for the country. And the double, triple negative would be a not so great Brexit deal that it doesn't address the main concerns, together with the Bank of England feeling like it's going to respond with actually negative rates. Who wants to hold this currency? It becomes almost like an emerging market currency. So I'm hopeful that some sort of reasonable deal gets struck, and yet one that still leaves that key UK financial services sector without reasonable passporting rights into the EU. But I think the ceiling to the upside for sterling is quite low. And here's the current account for the UK in red. And you can still see it's still at minus 3% of GDP despite years, really a decade of a very cheap sterling. What level of sterling does it take to get this current account shortfall balanced out? I think Steen covered the election quite thoroughly. Just going to take a sip of water here. I think the main uncertainty here continues to be, in the wake of 2016 election, the quality of the polling data and whether they've learned enough lessons. There are a lot of these polling agencies that have really done what they can and bend over backwards to change their methodologies. But there's so many questions on this election about turnout because of COVID. There's the risk of voting patterns and the voting count unfolding in a very strange manner where it looks like there's a very strong Republican vote early on, so-called red sunset, but blue dawn, meaning that as the mail-in vote, which Democrats are more likely to do because it's crazy, but the virus itself has become politicized in the US. So the marginal Democrat is much more likely to vote by mail. In any case, the polls are very wrong, especially and almost exclusively wrong by a large margin in 3 key states that I've circled in yellow here. This is where the uneducated white voter showed up. The marginal voter that simply didn't go to vote before suddenly did vote, in part responding to Facebook ads. And 80,000 of these was the margin. 80,000 votes in these 3 states were what gave Trump the election versus Clinton. So that'll be the key question this time around. The very best possible turnout for Biden, if the polls are remotely accurate, would see him take all of the states that I've circled here. And for example, a 360 to 180-ish turnout in the Electoral College. That is the key. The general popular vote is at levels that were never seen anywhere close to the election between Clinton and Trump. So I think all the outcomes are from anywhere from a staggering Biden victory together with the Democrats taking the Senate and all the way to a super slim Trump victory if the polls are badly wrong. And I think that could unleash something almost resembling a literal civil war if Trump wins again with a minority of the popular vote. One of our outrageous predictions for this year, by the way, was that we would see the Democrats with a clean sweep of this U.S. election. So it'll be interesting to see if that's the case. It was also the outrageous prediction that got the most pushback from our readers. So let's take to me, I understand what Steen says, and I must admit there's a corner of me that is very uncertain on this election. But let's assume we do get a Biden win and the Democrats do achieve a sweep of the Senate. And it is so important for that to happen if we're going to really see serious change politically in the U.S. outside of foreign policy. The president really can only do foreign policy when he does not have both houses of Congress on his side, because they have the power of the purse. The U.S. Congress has the power of the purse. So that's rule number one. And there of course, among the spectrums of outcomes, it is a bigger hurdle for the Senate to go to the Democrats than it is simply for Biden to win. In any case, let's say we do see a Democratic clean sweep. What will that mean for the dollar potentially? Well, the good thing for the dollar would be sort of the end of the volatility in U.S. policy, the whole random Twitter feed aspect that was so distracting, especially around the U.S.-China deal. When we were looking at the last 4 years, if we do see some tax rises, the third point there under the good could be some credibility on the budget side to help the revenue side, maybe the less extreme budget deficits. And as well, if there is a bigger mixing in, there's more high likelihood of a bigger mixing in of fiscal programs to support investment, which is a better use of money and is more supportive for the economy and for the dollar than simply this splashing of cash into the economy that I talked about before. The bad is that no matter what, the dollar is overvalued. If the fiscal is huge without sufficiently offsetting tax revenue, the Democrats supposedly have a much more higher propensity to spend in general and be more generous and round-headed in general. That's a negative as well on the real interest rate front, on the fact that the Fed will have a harder time absorbing that without impacting the currency. If they take a full-on MMT sort of platform to satisfy the left wing of the party, higher inflation risk there. The whole reshoring, there is an element of the Biden program that does include an anti-China stance, does include a domestic focus on reshoring production, particularly of pharma, PPE, etc. And then the Asian mercantilist model is essentially done. This whole thing we saw since the 1990s, really, of Asia supporting a weaker currency and recycling their trade flows back into forex reserves. This model is largely done, certainly in a growth sense. And that means that at the margin, the dollar is weaker from that. Same for oil, especially as the U.S. is more independent there. And then the ugly, these are random things that could be very bad for the dollar. What if there's a broader antitrust move against these greatest stocks of all time, the FANGs, especially from foreign regulatory bodies? U.S. political social dysfunction. I think if the market rallies, for example, if I'm shocked and Trump does win this election, I think I would like to sell that rally, because I think the risk of a social disorder is massive in that case, and he would likely not have both houses of Congress, and the spending patterns would be very haphazard under a Trump second term. Less investment, more random cash injections, etc. U.S.-China, I think Steen did a great job covering that ongoing rivalry risk and reshoring is, and again, an inflation driver. And Russia, I think it is a specific current concern for people investing in Russia, because I think the Democrats will be far harsher on Russia in terms of sanctions. U.S.-China is just to remind us, it's not just about the specific company angle of things, but also about the creation that this dollar as global reserve currency is a huge risk for China, so they need to mitigate that risk by offering an alternative. And I think actually this last 4 years has taught them that they will need to come up with that alternative, and I think they will do so with some kind of reserve asset that at least helps serve and grow their we'll see its use grow in terms of trade, and not just with the Irans and Russias of the world, but increasing other at least regional trade partners. And I think that this is a lot of text on this page, and I'm running over time, so I just want to pull out the last bolded bit here on my final slide, and that is that we've seen through this crisis that actually the foreign exchange has been a very low volatility asset relative to past global crises. A couple of drivers for that. One is that once you start to get all bond markets crushed to zero on the policy front, there's no real sort of prospect for anybody to raise rates by very much, or even cut rates by very much. It naturally avoids the volatility from policy response. Back in 2008, you had Australia starting at a yield of over 7%. Now it's starting at a yield of sub 2%. But as we go forward and we see more countries globally with these zero rates and controlling the yield curve out the curve, and not sort of allowing any price discovering in their bond markets, as they do fiscal policies and fiscal supremacy rises to the top, it'd be interesting to see if actually FX becomes the last sort of market where there can be some price discovery as countries either overly indulge in fiscal response and drive the negative real rates like are being predicted for the US, and if so, how that affects the FX market from old-fashioned fundamentals like trade deficits, current account deficits in particular, and relative inflation levels and relative real inflation levels, most importantly. So that's just a question that I'll like to see answered, I hope, in 2021. And with that, that rounds off my presentation. I'm sorry if I've gone a few minutes over, but I hope it provided some thoughts for your outlook into both the election and the new year.
Excellent. Thank you, John. And yeah, I mean, you both covered so much ground. We do have very limited time for Q&As. So I wanted to, one of the key themes in both of your presentations was that investors should expect volatility. And Steen has even made a case for being long volatility. One of the questions from the Q&A has asked how volatility can be hedged ahead of the election results. You did highlight that volatility has become quite expensive in these markets, and with the negative roll yield that's built into long volatility products, as well as the potential for the historic consistent kind of outperformance of implied volatility over realized volatility. How can investors consider strategies for hedging themselves against volatility without overpaying?
Yeah, so what you allude to in terms of the role is pretty much the short end. If you look at some of the VIX ETFs that is in the mid part of the curve in volatility, they're doing phenomenally well. So it's pretty clear, as you say, with the role that you have a very steep curve, and through that you are bleeding sort of volatility when you remain long the short end. So number one advice is to simply just take 3-4% of your portfolio and put it into the mid part of the curve. The alternative, of course, is more proactively look at your portfolio. Say you are a European-based investor, then you can very, very cheaply buy both weekly and monthly put option on your portfolio, and it doesn't need to be inside sight. I mean, you can do 20 delta puts on its own if it's specifically election. But I will say my point is really that let's go back to February, March. The VIX, the mid part of the function. The short-term VIX was up at 400, was up 400% in February, but the mid part was up about 200. Imagine you had, for argument's sake, 10% in the mid curve in February and March. You would have made 10% times 200%. You would have been up 20%. To sit against the losses that we all experience, both in the bonds and in the equity market. So I think, Zachary, the overall point here, you're not long volatility to be making money. You're long volatility because it is the only assets that is negatively correlated to the risk on trade you have in place. So sort of, I'm really saying essentially, you can bleed a little bit every month, that's okay, because at the time, the very time where you need some positive hedge in your portfolio, these kind of things will kick in. But the immediate sort of answer to the question is look at the ETFs, which is in the mid part of the curve in terms of the tenor, the expiry, and there you have a far more stable return. To the extent that if you take the midterm VTX in the US right now, they're up between 70 and 100%, despite the fact that US equity is up to all-time high right now.
Thank you, Steen. So in your presentation, you had also highlighted the Federal Reserve recently announcing the move to flexible inflation targeting and the impact. This is one of the most dramatic policy shifts coming out of the Fed. They also indicated that they would effectively likely abandon the NIRU, or the natural rate of unemployment, as a mechanism by which they might seek to increase rates. Looking back at recent rate increases when unemployment was at around 3.5%, having not had the impact that they had hoped in the economy. Actually, expanding on that, maybe I could ask John, how does that play into your outlook for US dollar weakness? Do you see the ECB having to adopt similar policies, or do you see a major policy divergence between the Federal Reserve now and some of the other central banks? Maybe both of you can touch upon that point, but I wanted John potentially to touch on the FX aspects.
Yeah, well, I think, as I tried to discuss on my final slide there, that I think the relative moves will be on the real interest rate front. If the ECB is, yes, the ECB nominally is lower than the Fed with its minus 50 basis points, and the Fed's essentially at zero. That really can't move. So the divergence has to come from somewhere else. And all other things being equal, the nature of the U.S. crisis response will be far larger on the fiscal front. And you're talking about an economic bloc, the U.S., or an economy, the U.S., with external deficits. So that funding has to come from somewhere. If it comes from the Fed, the risk being of even harsher negative real rates, whereas Europe has been the largest current account surplus bloc. So it actually has more ability to do the fiscal without the external implications as much. So that's where I look for the divergence and relative thing. But no doubt, if the Fed is going super aggressive if the fiscal is going super aggressive in the U.S., and you're seeing the euro backing up aggressively, it just invites the next response. So there is some limit to how far the exchange rate can be stretched before various countries are sort of forced into the competitive devaluation game in relative terms. I don't know if you want to add anything to that, Steen.
Only the point that I think that it's super important for investors to understand that Federal Reserve now is led not by Powell, but by Richard Clarida, who is the vice chairman. Clarida's single purpose in life has been to make full employment the number one priority for the Federal Reserve, which in itself is obscure. For why would a monetary policy authority have the ability to create jobs? But nevertheless, the Federal Reserve today is saying actively, proactively, and in terms of their policy choices, that full employment is the number one priority for the Federal Reserve, which means that they're going to provide you liquidity and print money and monetize debt forever, Zachary. So going back to the core of the question, this is inflationary because you now have an infinite support policy-wise, both from governments and central banks, to continue to throw money into the economy through the single act of getting full employment. And again, then we can start discussing what is really a full employment.
Well, I hope you don't mind us going a little bit more over time, given that there are really interesting questions coming in on the Q&A. Maria Zhao has asked about how investors can increase their exposure and asset allocation to China, considering capital controls and potentially an overvalued stock market. Now, Steen, you touched upon the increasing opportunities in the IPO market in China. There also seems to be, the largest IPO in history is happening imminently at Financial. We, as Down the Capital, we fought very hard to get an allocation of that for our clients. This is not happening on the New York Stock Exchange. This is happening in Hong Kong and in China. So what does this Ant Financial IPO say about the future of capital markets, equity capital markets shifting further east, and how do you think investors can play that shift in their portfolios?
So first of all, I'm happy to say that you can do all the trading you want in Red China through Saxo Bank, and you can even do the IPO on Hong Kong as well in China. And this is not a commercial for Saxo, but the how is you can actually do that on a Saxo platform already. But your bigger point, of course, Zachary, is the fact that what happened during the Hong Kong crisis constitutionally was that the Chinese company that used to be listed in the US was forced to go onshore in the Hong Kong exchange. So all of the major IPOs that we will see in the market will come into the Hong Kong space, and Hong Kong will, unfortunately, politically, of course, be totally under the rule of law of the Chinese authorities and the likes. But that also means that the activity in Hong Kong will increase in numbers in terms of the depth of the market and the accessibility to Hong Kong. Of course, you all know that you have always been able to trade Hong Kong pretty freely under UK law, effectively. That is still the case. So for me, this is really about China is cementing the fact that Shenzhen and Hong Kong ultimately will be one trading zone. It will be where the technology companies was born in China. That's where they're going to be extended now, because basically it is this high-end technology area for China. And China is going to continue to deepen the market. And that also goes to the overall conversation John had about, even if we wanted a reserve currency for the dollar, what should it be? I mean, should it be renminbi in its present state? Unlikely, because of the capital controls and the like. But if we move to digital and we move to a reservoir, and this is important for a macro point, if you have a reservoir that is ever deeper in terms of the ability for like you, Zachary, and your funds to invest and my funds, if the market is deep enough and we have access enough, then we will have to allocate it, because we are all short China relatively to where we should be, both in GDP and certainly relative to where GDP is in 10 years from now. So for me, the driver here is nothing to do with politics. It's all to do with the fact that the Hong Kong Stock Exchange will be where all of the delisting in America of Chinese company will come into play, and all of the 60% of all IPOs that we see over the next 20 years, I will make a rough guess that 30-40% of those will be listed in Hong Kong, primarily together with these CSI 300 in Shenzhen. So I think, this is one of the gravity laws of economics that we need to respect. And I think, I remember when we came up with our climate call last year, people say, oh, it's too expensive, it's wrong. And I think one of these things, it's, this market well enough, Zachary, that this is sentiment, right? It's when the sentiment turns, the momentum change, things change. And I think if you look, I could almost put the question to you. Tell me where you see the excess return over the next 5 years relatively to this world of real interest rate of minus 150. Still positive interest rate in China. Still, an IPO market which is, dormant relatively to the size of the market we see out of Silicon Valley.
Well, I would love to continue this discussion for another hour. We're already 10 minutes over time. So all I can do is thank you both so much. Thank you to our audience for engaging in this session. It was so great to see so many of you joining us. For those of you who are joining us after the fact on YouTube, again, remember to like and subscribe to this channel. Please sign up for the AIM Summit live webinar so you can ask questions, participate in the Q&A, engage with our speakers. Again, all the areas that we covered, we discussed that this is quite different from the GFC, because we have not only QE, we also have fiscal expansion. We talked about how flexible inflation targeting and some of the policy shifts of the Federal Reserve are going to have long-lasting effects. We discussed the potential outcomes of the election, a contested election, a clean sweep by Biden or a Trump win, the potential impacts that this has on the different shapes of the K. We actually showed how the misery index embodies the shape of this K recovery, and this is something that has been published by Saxo. We actually also highlighted, though, that historically elections have actually had much less impact on financial markets than investors seem to expect. As Steen highlighted, there is actually very little, if not any, correlation in financial markets happening in election seasons compared to normal seasons. It would be hard to argue, though, that this election might be a little bit different given the strong divergence in policy between the different parties and the potential for a clean sweep Biden win, as well as a Democratic take of the Senate and the House to actually result in policy changes that will have an impact. We discussed concerns about solvency, of companies, that pumping liquidity into the system is not going to save us forever. We discussed the importance of being long volatility. We discussed in depth and what is a huge issue and continues to affect investors and will continue to affect investors is that it's not just about the U.S.-China trade war, it's about this tech war. and the tech war potentially having a bigger impact for all of us in the long term. We discussed the impact that this is having on currencies, the fact that the outlook for US dollar weakness is only getting stronger, but at the same time that there remains no viable alternative to the US dollar as a global reserve currency. We discussed again, the euro, we discussed the JPY, we even discussed the Aussie dollar at length and some of the fundamentals underlying the other currencies. I encourage you to engage with Saxo on their platform. They have an excellent platform, excellent research, a great team, and we found them to be a great organization to work with. I'd like to invite you all to join our next session happening next week on Wednesday, October 21st. We're going to have none other than the legendary Mark Mobius discussing ESG, environmental, social, and governance investing in emerging markets. That session is going to be sponsored by Fitch Ratings, taking place again on the 21st at 4 p.m. GST, Gulf Standard Time, 2 p.m. Central European Time. That's going to be moderated by Mervyn Tang, the Senior Director and Global Head of ESG Research at Fitch Ratings. Again, thank you both so much, and a big thank you to Saxo Bank for sponsoring this session and making this all possible. It's been incredibly informative. The only thing I wish we had was more time.